Hello everyone, my name is Harsirat Kaur and I'm your professor for the course Introduction to Finance. Well, in the first module we have covered the basic information about the finance, like what finance is all about, what are its uses, how we use finance in our day-to-day activity or in business operations. However, in this module, we will learn about financial statements. What are financial statements? How we can use them? What are their use? And what information do they provide to us? So this is the very key element in business operations to understand the financial communication. Actually, I always say it like a financial communication because and the information that we get from the financial statements is a kind of communication. It's a communication, it's a way of communicating financial information. So you get the information from these statements and then you take the decisions into the company. So these financial statements are very important, and the understanding to create them is essentially important as well. So in this module, let's learn about that. So the objective of this module is to identify and to prepare the financial statements and explain how they relate with each other. So financial statement and their interrelation. So what is interrelation? Now we cannot say like this that all the three financial statements we can use them as an alternative to one another. No, we can get the information out of them, and all that information is related with each other, but they are not the alternatives of each other. So every statement has a viewpoint of the company. So every statement provides us with a different view about the company. So for example, balance sheet. Balance sheet is a statement which provides us a snapshot of a company at a particular period of time. However, on the other hand side, income statement provides us with the information about the revenues and the expenses of the company and what is the net income during the period of the time. Similarly, the cash flow statement tells us the information about where the company have spent or have gained the cash flows, whether the cash flows have come into the company or outflowed. So this kind of information we get from all of them, and these are interrelated with each other. So first of all, what is financial statement? So financial statement is a statement which provides us information about the financial position of the company and how the business operations work in a company at the end of the accounting period. So for example, we are analyzing the period of 1 month from 1st of October until 31st of October. So the balance sheet will provide us information about on 1st of October what is the position of the company, and on the 31st of October what is the position now, how much assets do we have, how much liabilities do we have, how much equity do we have. On the other hand side, income statement provides us information about the whole period, that during this 1 month, during this whole accounting period, what was the income of the company, whether we have gained profit or loss. Traditional statements are balance sheet, profit loss, and cash flow statement. So here are the objectives. Now objective is about why we prepare these financial statements. What is the use of these financial statements? So the basic objective of preparing the financial statement is to know about the position of the company. For example, how much assets do we have? Assets means the things that the company own, or how much liabilities do we have. It is something that we owe to others. Maybe it could be debt, could be loan, could be short-term liability, could be long-term liability. Something that we owe, that we have to pay. To provide various information to the stakeholders. So there are many financial users, for example, internal users and external users. that we have studied in the last module as well. So it is very important for the stakeholders. So stakeholders are the people or group of people which are related directly or indirectly with the business. So what is the true value or a fair value of the business? To forecast certain financial points in the business, like how much loan do we have, how much debts do we have, what is the capacity of the business, do we have liquid assets or not, do how much cash do we have in hand to run the business. Okay, so it tells us about the credit worthiness of the business as well. So what is the worth of the business? Okay, to decide about the future of the business. So all the financial information that we get from these financial statements provide us with the decision that how should be the future, what future steps do we have to take. Uses of financial statement. So financial statements are being used by internal users and external users. So who are the internal users? Management, customers, and other users, for example, government agencies, to the public, financial institutions. So whenever two companies have to do the business, they read their financial statements before to know about what is the condition of the business. Okay, business and the business partner as well. On the other hand side, for example, if the bank has to credit you a loan, then they also go through your financial statements in order to analyze whether the company would be capable in the future to pay back the liability or not. Okay, this is a video on the retained earnings. Like, what is retained earning? So retained earning means that the amount of money left in the business after paying the liabilities, and this amount of money could be used by by the owner in order to invest for the future investments in the business. So if the investment that have been done by the investor is done well, then this retained earning can lead to productivity and more profit. However, if the retained earnings and the investment that have been done is not bringing any productivity in the company, it means we are doing the wrong investment. So here you can see.
Retained earnings are the portion of the company's net earnings that it doesn't pay out to shareholders as dividends. The company keeps this money and reinvests it in the business or uses it to pay off a portion of its debt. To see how much of its earnings the company has retained, look at the balance sheet under shareholders' equity. Retained earnings can also be reported on a separate statement called the Statement of Retained Earnings. You may also hear retained earnings referred to as the retention ratio or retained surplus. When companies reinvest their retained earnings, they're expecting to earn a return on that investment, whether they're investing in new machinery, research and development, expansion into another market, or anything else that would help the company grow or become more efficient and profitable. Increases in a company's share price or its earnings per share over time are good indicators of how effectively the company has been using its retained earnings to help the company grow. If a company is retaining its earnings, but earnings per share aren't increasing, the company isn't growing and investors will want to receive a dividend. If the company is neither improving profitability nor paying a dividend, investors may want to pass. Anything that affects a company's net income, such as a change in its expenses or revenue, will affect its retained earnings. If the company increases or decreases its dividend, this action will also affect retained earnings.
So another video is about depreciation. So what is depreciation? Depreciation means how much the value of an asset has been depreciated over a certain period of time. Let's say if the company have bought $500 worth machinery and the machinery have been consumed until 5 years. If the 5 years, each year the 10,000 $100,000 are coming back to the company. At the same time, if the $100,000 are going out of the company and the 500,000 have been depreciated, that we have spent have gone out of the company, and eventually it turned to be the $0 that we are gaining nothing and the machinery have ran out, so that is called the asset have been depreciated. So you will see the video after a certain period of time. You can see it in the PPT that I will upload. So now we will talk about financial statements. There are three statements that you are looking. First one is income statement, another one is balance sheet, another one is cash flow statement. So these statements are interlinked with each other. Whatever information that we get from the income statement gets into the balance sheet, you can appear it in the balance sheet, and the cash flow statement and the information that we get from that also depicts in the balance sheet. Okay, so income statement. Income statement tells us about how much revenues do we have earned and how much expenses do we have made on the income tax and the taxes and the other expenses. And after going through that, whatever we have earned, what is our net income, whether we are gaining or we are losing. Another one is statement of owner's equity. It helps us about what is the owner's own equity after reducing liabilities from assets. Another one is balance sheet. Balance sheet tells us about what is our assets, what are liabilities, and what is equity at a certain period of time. And cash flows tells us about cash inflows and cash outflows. So here you can see the balance sheet. What is a balance sheet? So balance sheet provides us information about assets, the things that we have right on, the ownership, on the things that we have ownership. For example, what cash do we have? How much is the inventory which is with the business? What are the account receivables? Account receivables are the amount of money that we would get in future for the services that we have done or for the products that we have sold. Liabilities, something which is an obligation which we have to pay. So could be notes payable, that we have committed someone to pay certain amount of money after a certain period of time, but we have an obligation to pay back. Some loans, we have debt through the suppliers, we have administration things, so that is a liability. We have to pay salary to the people who are working for us, is a liability. Another one is equity. So equity is whatever we have left after subtracting the liabilities from our assets. So that is called an equity of the owner. So here is an example that we have and that you can see. So there are numerous information that is here in the form of raw data, and you will figure it out in the form of balance sheet. We will create a balance sheet out of this data. So let's see here. Account balances for Crystal Auto Wash at September 30, 2011 is shown below. Information regarding the retained earnings is not given. that we will find out. I will explain you how. Okay, but it can be determined when all the available information is assembled in the form of balance sheet. So we will see here, we have information about accounts payable, account receivable, buildings, cash, capital stock. We have to find retained earnings. We have land, we have machinery, we have notes payable, salary payable, and supplies. So what is account payable? That is something we have to pay. That is a liability. Account receivable, that is a asset that we will get. It's a long-term asset, but it's an asset. Buildings, this is an asset that we own. Cash is an asset. Capital stock is an equity. Machinery and equipment is an asset. Land is an asset. Notes payable is a liability. Salary payable is a liability that we owe. Okay. So if you see here, you can see here all the information about the assets and the liabilities and the owner equity. And now I will let you know that how we have calculated the retained earnings. So for the retained earnings, it means what is owner's equity minus capital stock. Capital stock means how much dividends or how much shares he has paid or how much investments he have done. After that, what is left is called retained earnings. So it is computed as, first of all, we will find owner's equity. So that is assets minus liabilities. That is $149,400. So now this is owner's equity. If we see here, owner's equity is $149,400, 149,400 owner's equity minus 100,000 is capital stock. Then what is the retained earning? It is $49,400. Okay, so retained earnings is the amount of net income that is left with the business after paying dividends to its shareholders. So that is the retained earning. This could be positive, that could be negative. Okay, so now they say that what this balance sheet indicates about the position of the company, Crystal Auto Wash. What is the financial position of the company? It shows that the financial information of the company is weak. Because why the company's financial position is weak? Because the liquid assets, if the company got the need got the need of money in the near future, then what are the liquid assets do they have? Cash or cash equivalents. That's only $10,000. But in the near future, they have liabilities of $46,000 that they have to pay. So their assets are less, their capacity of paying their debts is less. So the company is in the weak financial position. So what do income statement and cash flow statement can explain about the financial position of the company? The income statement for Crystal Auto Wash would show company's revenues and its expenses over a period of time. This information will tell us whether the company is gaining or losing. If their expenses are more than the sales, then it means they are facing loss. But if the expenses are less than the revenues, then the company is successful and is making some business. On the other hand side, the cash flow statement. Cash flow statement for a particular period of time will explain about what are the inflows of the cash in operating activities of the business, in investing activities of the business, in financial activities of the business. So it will help us to understand what is the ability of the company to pay its obligations, to pay its liabilities in the near future. Another one is income statement. Income statement lists about revenues and expenses, and it is done on the basis of accrual basis accounting. Now, accrual basis accounting is a kind of accounting in which the cash, even which is not paid yet, is considered to be an exchange of money. So how we find out profit or loss? Profit or loss is find out by subtracting expenses from the revenues. So here you can see an income statement from Under Armour, and we will understand how the income statement explain different kind of elements of the business. So first of all, if you have seen here that the revenues of the company are $3,084, okay, and the cost is 1,572 negative, okay. So they are making the gross margin before paying taxes or expensive, which is quite good, $1,512. So 49% of margin, quite high margin, which shows that the company is not a manufacturing company. They do not manufacture, they outsource their production. However, on the other hand side, even if they do the expenses, while subtracting their expenses, they have high non-direct expenses, which means that that could be of marketing or publicity. They may need it, right? Another thing, after paying their interest, after paying other expenses, the income tax before taxes is 11%. After paying, for example, they say marginal impact of interest and financial expenses due to high cash surplus seen on the balance sheet. So it means that they have high amount of cash surplus that they could invest on other activities. That's why they are paying high rate of interest. On the other hand side, the net income is more than 10%. Quite great net income, which means that before the taxes, if you see it's 11%, it means that they are gaining quite good revenue. Another one is cash flow statement. So cash flow statement is a statement which tells us about what is the liquidity of the business. Liquidity of the business means what does the short-term capability of the business to pay the short-term liabilities. On the other hand side, solvency of the business as well. Solvency means the capacity of the business to pay the long-term obligations with its long-term assets. So, operating activities are the activities which are the normal business operations, for example, paying salaries, sales, costs, wages. On the other hand side, investing activities would be whether the company has bought or have sold fixed assets like land, building, property, equipments. Financing activities means whether the company has taken the debt or have given the debt or have issued the shares or have bought the shares. So definitions of whenever the cash comes into the business, that is called cash inflow, and when the cash goes out of the business, that is called cash outflow. So this is the cash inflows are always positive and the cash outflows are negatives. So cash equivalence means something that could be turned into cash in the near future, very soon. So having maturity less than 3 months, okay, subject to insignificant risk of change in its value and held for meeting short-term obligations. Okay, so how should the cash flow statement should look like? So cash flow statement should look like it should have all the cash flows, inflows and outflows related to the operating activities, relating to the investing activities and the financial activities. Inflows would be depicted by positive and the cash flows should be negative. Okay, so here you go. Okay, what could be considered as investing activities? So investing activities are the one in which you have bought or have sold the fixed asset. Okay, so for example, cash payment to acquire a fixed asset. Fixed asset could be a building, could be a land. For the resources intended to generate future income or cash flows, for example, you have bought a land and you are going to have something over the land. Maybe you are going to rent that and you are going to have cash from that building, from that fixed asset. So that is called of investing cash flow activity. Cash receipt from the disposal of share, if you have sold some shares, okay, or you have done some mergers or acquisitions. So financial activities are the ones in which you have either given the debt or have taken the debt or some share issues of some shares or similar instruments. Okay, cash repayments of the borrowed funds as well. For example, here is an example in which they have shown that the various entries that have been done until from 20th January to 31st of January, which are the cash activities that have been done by Michelle McBrien in his business. So Michelle McBrien have invested 80,000 euros, dollars, $80,000 received from the sale of capital stock in a company's bank account. So he deposited it to start a business. He purchased a land for $52,000 paying cash. So what is that? He purchased a land. It means it is a investing activity, right? He purchased a building by paying cash. For how much cash he has paid? It's $6,000. So you will see the whole information in here. So he have purchased land, he have purchased building by paying $6,000. He purchased tools for 6,800. So all these are the investing activities. However, what are the operating activities? Operating activities are the ones that are being done in day-to-day life. For example, cash received from the sales was 2,200. Cash paid for the expenses was $1,400. So what are the cash that is obtained from operating activities are $800. Okay. What could be the financing activities look like? $80,000 he has achieved from the sale of capital stock. Increase in the cash for a period is 1,600, 600. So how we get that? You can see here. So how these statements are interlinked with each other? All the three statements are interlinked with each other. However, we cannot use them as a substitute, but yes, we can relate. The information that we get from income statement is shown on the balance sheet, and the information even from the cash flow statement has shown in the balance sheet. So for example, what are the investing activities? What are the operations that we have done? So we can see it in the income statement and in the balance sheet. So here is an example. So net income is 12. So that is the retained earnings. You can see here 19 minus 7 is 12. Okay. So another thing you can see it on the net income is you also seen in the cash flow statement. So in this way we can see the information in the different statements, but a similar kind of information. However, the different income statements represent the different views of the company. Okay, so thank you so much for attending the presentation. So if you have any question, you can write me an email. So see you in the next module.